Hey trader, Stephen Kwitzel here. It's Friday, December the 1st before the market opens. Today we're going to have a lot of fun today. I am going to completely bash myself in my worst trades of the year. I've done this webinar every single year for the last couple years and I've gotten really positive feedback. We all make boneheaded mistakes, and if you're like me, you make them almost daily and you just learn from them because I'm in the market so much. So share with me your stories. If you made one mistake of the year that you're just man, it's just really giving you nightmares, just email it to me. I'd love to hear it, just because we're all humans and we celebrate our wins, but it's also extremely important to analyze our losses. And that's what I'm going to do today. I have about a dozen or so trades that I've made, and I'm going to analyze them right in front of you of mistakes that I made or things that I should have done better. And we're going to get better together. So let's start with the NASDAQ. Now, this is yesterday's price action. If I look at this, let's see, the 29th, that'd have been Wednesday. Man, the NASDAQ and technology just got whacked. So sometimes, and it's worth paying attention to, and this is something I learned from IBD because that really helped me build a foundation of investing. They talk about when the market's going to go under a correction or, in a pullback. Typically, the growth stocks or the leaders are the first to go. Now, what I mean when I say that is if the market has, been on an extremely strong trend like it is, let's say the market's up 15 or 20%, these are the stocks that have doubled and tripled. So you have your technology stocks and you have a lot of these Chinese stocks, which I trade, which are extremely volatile, but I mean, they can move and they can move quickly. They just got taken out to the woodshed on Wednesday. So sometimes when I see this, everything looks good on the S&P and everything looks good on the surface, but then I see some of these leaders just getting hit, and I'm a growth shop. I start to pay attention a little bit. Now, everything's still bullish, don't get me wrong, but just sometimes you want to look at the things that aren't so obvious. So the NASDAQ, and as I'm looking at the futures Friday, they're down a little bit. But if you look at the S&P 500, everything is all good. But guys, this is almost really seems parabolic in my opinion. I wouldn't be surprised if it comes down, and I mean, it's probably going to come down and test the 50-day again. I mean, this is just, look at this bullish cup with handle. I mean, geez. I can't remember. I mean, 2013 was this kind of market where it just went straight up. And if you were waiting on the pullback, you were just sitting there twiddling your thumbs for a long time. I know a lot of money managers that were waiting in 2013 for a 10% pullback to put some money to work, and it never happened. So, and I think that's what's going to happen. We could get a 2-week correction, in December. But you're going to have a lot of these institutions that have underperformed this year, and they don't like to underperform. So they could, I'm just guessing, this is a guess, but they could push up the market in the final weeks of the year to make sure they get that outperformance, or, do a little window dressing. So, I would say the S&P 500 is overbought. I don't think anybody will really argue with that. Now, I don't look at, so a lot of times overbought because things stay overbought in a bull market. But I would probably wait for the market to come to me a little bit. Boy, that small caps, the Russell 2000 looks good, doesn't it? It's so funny because just when you think that it touched the bottom of this stair right here, of this box, man, it just went straight up and then created a little bullhorn, and then it just went straight up again. Financials, by the way, I'm going to tell you why I was wrong. Yesterday I said be careful for financials, and because it was looking like it was coming in, and then yields popped and banks popped, and I changed my mind immediately. We'll talk about that. But I mean, this is obviously straight up. This is straight up from the bottom. So all I say is, maybe you just you let the market come in a little bit for a few days before you resume your buying power. If you look at the relative ratio for the small caps of the S&P 500, it broke out from a relative ratio of the downtrend, and it came down. And whether it's a stock or a relative ratio or something, this happens all the time when you have a breakout of a downtrend. A lot of the takers are buying up here, and the makers are selling, and then it's going to come back and it's going to test this downtrend is going to shake people out. Makers are buying the downtrend line, that first test, and then pushing it back higher. So the makers are buying here, they're selling here, they're buying here, and most takers are buying here, they're getting stopped out somewhere around here, and then the makers are scooping that up. So just kind of keep that in mind. You know, when most things are going to come back to test the initial pivot zone. So don't get scared about having to about getting left in the dust. So what I do is my typical routine. I'll tell this, when I look at breadth, it's more a part of my weekend routine, because breadth, you know, it's kind of a slow moving, not necessarily lagging, but it's a little slow moving, and it's a secondary indicator, so I don't watch it like a hawk, but I watch it weekly. And if you can see, this is the S&P 1500. Man, there's nothing wrong here. Look at that bullish chart. It looks good, right? So, and then you have the breadth of the S&P 500, the mid caps, the small caps. And if you remember, when the small cap breadth gets under 60, and this is percentage above the 200 day. So if it gets below 60%, above the 200-day moving average, a lot of times the market will go into a correction. So then you have this, and this is why, this is just a textbook example of why don't make initial decisions on secondary indicators. The breadth peaked right here along this line. On every breadth it peaked. You can see the breadth started going down, started going down, started going down, while the market was going up. So that's just a yellow flag for me, but I'm not going to really pay attention to that until these trend lines of these markets start to break. Because look, it just really came down a little bit. The small cap breadth came down a little bit, and then now it's just bullish reversal, bullish reversal, bullish reversal. And if you would have made decisions, and there's nothing wrong selling in a strength, but all I'm saying is secondary indicators are called secondary for a reason. And if you would have made decisions based on breadth, on this chart at least, you would be wrong. So just keep that in mind. But it's just interesting to watch it happen, watch these development happens. And you're like, okay, breadth's getting weak. Let's wait for the price action to get weak. And it gets weak just a little bit right here. And you say, here it's coming, and then boom. Okay. So that might have rattled some people a little bit, but man, I mean, this is a raging bull market. It is. And it doesn't mean buy with abandonment. You still have to have your rules, but you need to expect bullish outcomes and not bearish outcomes. So, you know, I used to suffer from something, what I call it's the big one-itis, and it's just a silly name I called myself. And every time the market would correct 2 or 3%, I'd say, oh, it's the big one. You know, and I just start selling everything. And that's so silly. And it took me years to work through this, to say, hey, you know, if you're in a bull market, I need to expect bullish outcomes. So that's a problem I used to have. And I try not to have that problem anymore. Let's look at treasury yields. So this is the 10-year treasury yield. And typically, and I want to go down here, and the yields are positively, for the most part, positively correlated with financials, banks, brokers, things like that. So when the yields are going up, that means banks are going up, most likely. And it's not perfect, you know, 1-to-1. But that also means when yields are going up, it's negatively correlated with gold. And we're going to look at gold next, because, you know, even when the stars are aligned, which I thought they were with gold, it's starting to, something can change. And one of my favorite phrases is from the great, the Wizard's book, The Interview. Eddie Sudoka says, hey, if you don't like whipsaw, then you don't need to trade. And that's true. Whipsaws are going to happen. They're part of it. You just have to be willing to handle it and make sure that you keep your losses small. So the yields have gone up. This is a weekly chart, 2.3% this week. You can see they came down, and even though it looked like that breakout was going to fail, it's firming up a little bit right at the downtrend line. So if this moves higher, that's positive for banks. That's bad for gold. And that sucks for me, because I made a big bet on gold, and I don't mind taking a loss on it. It's part of it, right? But it's something to be conscious of, because based on the gold action and based on how dollar was incredibly weak, just everything was telling me, looking at it objectively, that gold was going up which could have put downward pressure on this, and then boom, it changes at the drop of the hat. And the lesson here is you have to be willing to change your mind with it. Do not stick your flag in the sand, or and say, nope, I'm right, the market's wrong. The market is always right, no matter what. So we're gonna, with that being said, so basically last week I think I said, hey, you probably want to avoid some banks and some financials. And I think I said retail was looking good. Maybe oil was looking good. Now I'm saying, okay, now you might want to reconsider that. Banks are looking kind of good, and we'll go look at some charts. But I do want to go look at the gold chart following this, because it's important to see intermarket analysis, and that's how gold and yields and dollars and all that stuff moves together. It's incredibly important to really, really understand sometimes. So we have GDX. And in this window, we have GLD gold, and it's curling down. And for a minute, it was curling up right here. You could see it came into this zone, and it's, this is a zone. So pivots sometimes, especially with commodities, they look at a zone. Sometimes it's not the exact dollar, but it came back in this zone and settled down. It was looking like it was curling up, while gold miners was breaking out, while it was coming at a double oversold, while the dollar was breaking down, and even the gold miners versus gold relative ratio was turning up. You can look at this chart objectively. If we were to cut off this week's worth of price action and say everything looks bullish for gold, and then yields popped, and this gold went down. So now you have to reconsider, and now you kind of got to wonder, okay, this downtrend in the dollar, is this going to curl up? Because then that's going to push gold even further down. So I look at this chart and I don't see anything wrong with my analysis. And gold could curl up. I'm waiting for this level, this 22.22 to get taken out in gold miners for me to just abandon my trade. But because I'm not getting involved in any of this. It's just not worth it. I can take a 3 to 4% loss and move on. But that's part of trading. You think, I just see so much evidence on this chart that this trade is going to work, and then something changes and I have to change with it. So right now, you have a little horizontal support with gold right here, and I could draw it. But you get some negative volume coming in, it hit and it came down, and maybe it settles here today, and we'll see what it does today on Friday. I'm recording this before the open, but if this gap's down again, I'm out, and you probably should be too. And it's just so funny, and gold is just if there is anything that I have been stopped out more, it's gold. And the funny thing is, I was championing myself for not taking this gold trade because it looked perfectly, but I noticed the dollar was looking like it was curling up, so I avoided this trade. So I was thinking I was smart, and I was saying, oh, no, now it's curling back around. Now is the real one, and now we're going to keep an eye on gold. So all I'm saying is, with gold, don't stick your flag in the sand again. You better be willing to pivot if the yields go up, because that's going to be bad for gold. So you have to, and that's why intermarket analysis sometimes is incredibly important. You have to know what's going on to be able to change your mind, because if you don't know how the gold works with the dollar that works with the yields, you might try to stay with this trade because you think it should go up. But the evidence elsewhere is telling you, hey, something's wrong. And I'm a sell first and ask questions later kind of guy. So right now I'm just keep an eye on gold. That's all I'm saying. Probably today we'll have its come to Jesus meeting, and we'll see what happens there. Oil is looking bullish. Actually, I want to draw on this for a second. So you got West Texas right here. So you got this trend line right here. I'm going to watch this right here. If it should hold, right? But this is a pretty good move from 43 up to 58. If I were to just kind of figure that out, I mean, that's a 37% move in oil since the summer. That's a pretty good move. So all I'm saying is, I like oil, but don't be surprised if it just doesn't go straight up, don't be surprised if it consolidates for a while, because I mean, we've played oil perfectly twice, right? And now it's coming down. The gold cross, actually here, whoops. The gold cross is happening, okay? So I'm not going to deny that. You got the gold cross right there. That's good. And it's just kind of consolidating, and it popped yesterday. So maybe it's going to continue its advance. All I'm saying is if it doesn't go straight up, that's really not surprising. It might have to, because this waterfall effect, it might have to work through some things and just consolidate a little bit longer. But that doesn't mean I won't trade gold today or oil today if I see something that just makes me think it's going straight up. But all I'm saying is this is a big move. Just you know, before you back up the truck, maybe ease into it a little bit. Okay, so we got oil, gold. Okay, so before I get into my mistakes, we're gonna switch gears here. We're gonna go over to Market Smith because it's kind of my baby. So sometimes when I talk about looking at the leaders, looking at the leading stocks, when they get whacked and the market still looks good on the surface, that's kind of when I pay attention, or at least my ears perk up a little bit. This IBD 50, this is their index. This is the best of the best. This is the best growth stocks in the market, based on fundamental and technical strength. This isn't just technical and relative strength. This is, you know, triple digit earnings and sales. So this is a good ETF, by the way. It has just crushed the market. This year, it was down 4% on Wednesday. So that, and on my cell phone, like, I keep lots of lists, but I really try to track just, you know, in certain indicators like gold, treasury yields, and things like that where I can easily access it from my phone, and then I'll go into my Market Smith app and look at my stuff. This is something I track, and I see, okay, what's this doing? Because this, to me, is the leader, right? This is the best inventory on the market. And when this starts to get hit, I say, okay, the leaders are starting to get hit. That could be, you know, a crack. And again, I'm not going to say it's the big one or anything, but I'm just saying it's sometimes it's worth noting. And then we had a pop yesterday, and then now this is just an ETF, and then it looks like the futures are cracking a little bit this morning. So just something to take notice. Okay, let me get a sip of coffee, and then we're going to go through we're going to go through a lot of charts. We're going to go through my worst trades of the year. So what I have is I have about a dozen trades that we're going to analyze, that I need to do better on, that I'm going to tell on myself for, and then I got 5 good ideas that I like. So you're going to want to stick around for all of this. QTNA. Okay. This is bad trade number 1. And what I'm going to do on each chart, I'm going to look at it, I'm going to analyze it, and then I'm going to say what I would have done differently, what I should have done differently. Now, this was a trade last year, towards the end of the year last year. So what I did was I noticed right around here, I believe, where was I? I was in here. Okay. Maybe this was earlier this year. So you have a perfect cup with handle on this, right? Everything looks good. The handle, really, sometimes if you want an early entry, you buy a breakout of the downtrend of the handle. And that happened. So everything was looking right. And then it started easing quietly, which is perfect, right? Exactly what you want to see. And then it broke out. And I said, you know what? The earnings and sales are so strong, I'm going to actually buy the breakout. Because I think it's going to continue to go higher and not revisit the pivot. Well, I was wrong, and I bought on somewhere up here, and then within 2 days, it just crashed, right? It crashed me out. Now, why it crashed me out, I don't exactly remember, but the moral of the story is I bought the breakout when I saw that the tight trading action right here is where I needed to be in. I needed to buy this, and because it was, you know, maybe my emotions got control of me, I said, well, I'm going to wait for a little bit more confirmation, even though hindsight, I had plenty of confirmation that this was a good trade. And then I bought on this one, and then I got completely stopped out, gapped down on me. If I would have bought right here, I would have sold half right here and raised my stop to break even for a gain. Instead, I sold for a loss. So, don't hesitate. If you see something right, it's completely normal. And actually, I like buying before the breakout under the pivot. If you see a little bit of accumulation coming in, and then you see a low volume pullback above support, which is above these moving averages, I should have bought in here and I didn't. I hesitated. I was waiting for more confirmation and I had all the confirmation I needed. Bonehead mistake. Lost 10%. Okay. Greece. I've been watching this for a while. I had this idea that Greece is in a depression and it's going to come out roaring, or at least the stock market will someday. So if we go to the daily chart, I bought somewhere around here. And it was just maybe, actually I think I bought here, and it was just volatile, right? It was volatile. What I should have done is I should have just, since I knew it was volatile, I should have kept looking at the weekly chart. That way my emotions and my detachment will be limited because I'm not looking at the daily gyrations. But because I was looking at the daily and I was focused on that, and I said, hey, it looks like it's rolling over, I sold it right around here, okay? But if I had waited and looked at the end of the week chart, it held support on the weekly chart, and then it made a very nice, 20 to 30% move. So I let my emotions get the best of me. I didn't look at the weekly chart. I focused on the daily chart, and then hindsight, it's very obvious to me that I should have been looking at the weekly chart, because then it made a nice little move. I would have sold half somewhere around here, and then I would have sold the other half right here when it broke support, and I would have been out for a nice gain. 6% loss. Yes. The one I think about all the time. Sometimes, guys, it hurts more when you have a trade that you sold too early or didn't buy at all and you should have. I made a trade on Alibaba. Everything was looking bullish. It popped. I thought it was going to do something like this and just ride the 10-week moving average. So I bought this first pullback, right? There's nothing wrong with that. Well, support broke and I got stopped out. So I bought it right. Okay, I bought it right. I bought it somewhere around here, and the support didn't hold, so I got out. Here is where the real screw up happens. It clear as day broke out of this downtrend, clear as day on above average volume, and because my feelings were hurt from the previous stop, I didn't buy it back. And look what happened. It went from $100 to $200, so just about a 90% move. And would I have held through all this? I think I would have held through most of it, because my original plan on this over here was, I believe it's just going to ride the 50-day moving average and I'm going to hold it until it breaks. I would have probably held at least half till this happened right here. So I would have made some really, really nice gains, but because I was chicken, because I had my feelings hurt right here, and because this is a downtrend. Sometimes downtrend looks ugly. When you come out of a hard downtrend, it's hard to pull the trigger. Your emotions are saying, no, don't do it. Look, you could get shaken out. But that's what you need to be doing. You need to be buying. And I sent this out in an email. One of the best blog articles I ever read was talking about mean reversion trades, and that's buying pullbacks, buying stocks when they look ugly, when, you assuming that, they look ugly around support and they can firm up. And this blogger who creates trading systems for a living had a post-it note on his computer that said, and the only thing it says, close your eyes and push the button. And that just makes me laugh, and it's so true. And I'll probably, my next mistake, have to do that as well. When you're buying pullbacks, sometimes it's hard because it looks ugly. Or when you're buying a breakout after just a long, ugly downtrend. But you know what? It happens. And before I go on to the other trades, I just want to show you, I was thinking of that. Now, this was a trade I lost on. But actually, it's a trade that I'm incredibly proud of, more for personal improvement, because look at this downtrend. This is ugly, but it found support, and I bought right here at the first 200-day moving average test of a high power growth stock. All the fundamentals were there. Just came down hard. Very reasonable to assume it would find support. It didn't, and I was out for like a 3 to 4% loss. But I wasn't angry about it, because normally the old Steve wouldn't have bought this. This trade could have easily worked and worked some things out. But my point is, I closed my eyes and I pushed the button on a setup that was very reasonable. And obviously, I got stopped out, and for good reason. It continued to flow lower with all the other Chinese stocks right now. But to me, this was a good trade, just because, you know, I saw a trade and I took it, and they don't all work out. But I patted myself on the back for doing it anyways. Facebook. Okay. Where were we at? We were right here. It's almost exactly where was that? Okay, this is right around, this is with Alibaba. Both Alibaba and Facebook were breaking out. I decided to buy Facebook, and instead, because this was so ugly, I wanted to win, and I took my profits quickly, right? I took a 5% gain, sold right here when it broke out. And then it went on to run another, 70%. So what I should have done is what I do with almost all of my trades right now is I'd sell half at a 7 to 8% gain, and then I raise my stop to break even on the remaining shares. And sometimes on the remaining shares, I look for the 50-day moving average to break. So I probably would have gotten out right here. But if you got a 5% gain on half, and then you have another 20% gain, I probably would have netted, 12.5% on the trade. And instead I netted 5. So, and I remember this because I was like, man, this is just kind of an ugly correction. Just take the gains and move on. Well, if I would have looked around to see everything else breaking out as well, I would have probably stuck with it. And I didn't. I took 5% gains and I watched it, right? So sometimes, a lot of times, my worst trades are are trades that I actually made money on, but I misplayed it. I had a big winner, and it all has to do with sometimes emotions. Speaking of emotions, Goose Island, Goose Island. I was thinking of beer. Good beer, by the way. So this broke out of a downtrend. I like everything about it, by the way. Year-over-year acceleration in earnings, good return on equity for apparel clothing. Everything looked right. There was accumulation in the right side of the consolidation. It broke out and it pulled back to test the 50-day moving average. We entered right here, which was perfect. Okay. So we sold, around a 7% gain, somewhere in here. I'm not saying on the top day, but somewhere around here, and raised our stop to break even. Well, what I did was, and some people might be mad at me, what I did was, I didn't let it hit the break even. I think I was in Disney and the market was coming under pressure. Everything was just coming under pressure. So I went ahead and just raised the stop and said, hey, let's just take all our gains out of this one. And I didn't let it come down and test the 50-day moving average. And I should have. And then it gaps up on earnings, and that sucks because it was up big on earnings. What is that? Is that a 32%? It gapped up 32% on earnings. I don't know if I would have actually sat through that. It kind of depends. But man, that hurt. It hurt because I had it. I bought it perfectly. I sold half. I raised my stop to break even, and I abandoned the plan, and then it gapped up. Part of it, right? I should have just let it go, let it hit the stop if it was going to hit the stop. Most of the ones that hurt the worst with me are the ones that I had it. I had the big winner, and I just misplayed it. Veil. This is a trade I did not take. And I should have. And I was staring at it, and I did my weekend routine, and I created a a plan. I created a plan over the weekend. Actually, let me redraw. I don't like that trend line. Let me redraw it. I created a plan over the weekend, and I said, okay, if this breaks out, I'm buying it. I didn't, because this is a pretty good correction, and I just said, man, that's volatile. Do I want it? And it broke out, and I said, okay, when it comes down and tests support, like I know it will, that's where I'm going to get in. And I just passed. I passed on it because I'm looking at this and I'm like, man, this looks ugly. What if this just cracks wide open? And then it goes on from $8.50 to $11. And I probably would have sat through most of this because it held the 20-day moving average the whole time. So it probably would have been a 20% gain at least. But my emotions said, this is ugly, stay away. And I made a plan and I did not stick with it. I'm better now, by the way, but it's, you know, like this is part of trading. Like you make mistakes, and you know, I'm putting myself out there right now to say I've had a really good year. I've had lots of wins. I've smoked the market, but I've made lots of mistakes too. And it's important for me to put myself out there, one, so I can really learn from it because now everybody knows, and two, so, you know, my wonderful paying subscribers can hold me accountable when I try to change the plan. So Queb, and this is really the, let's go to the daily chart. No, actually, I want to go to the weekly chart. This is the Chinese Internet ETF, and you know me, I have an affinity for Chinese stocks. Okay, so, and I had no idea this was going to make this move, but, you know, I should have bought this downtrend breakout right here because it just came out with a cup with handle, but this is so volatile. It is a volatile ETF, but it's a good one because, you know, there's a lot of growth in the holdings in this ETF, but I should have bought the breakout. I didn't because it was so volatile, and then it went up. So this was a trade I did not take. It's on my watch list, and it's just, it's too volatile for me. Should have done it. I should have closed my eyes and pressed the button. VRX. Now, this is a trade I don't know if I would have taken anyways. This is another one I didn't take, but it's something to analyze. We all know Valiant Pharmaceuticals and the big hedge fund guy that Bill, what's his name? You know who I'm talking about. Bill Ackman. You know, he owned a lot, and then they had some problems, and, you know, they lied, they cooked the books. Long story short, the stock went from like $260 to $8. Okay? Is there some value to this company? Probably. So then it starts to come up. You got the golden cross, that's fine. It's probably going to come out of this long rectangular bottoming pattern right here. So it popped. One day it popped, and I don't remember why. Popped like 17% on 600% above average volume. And it came down, and it reversed right at the 20, 50, and 200-day crossover. So this should have been an entry, and I think I missed it. I'm not sure if this was a trade I would have taken anyway, but this is just a good one to analyze. And why this is a mini lesson right here is because when you see all this volume, all this above average volume stepping in, and then you see a pullback to a cluster of moving averages, it is likely to hold support because all the institutions that bought in right here, they are unlikely to turn around and sell it. And maybe this was a short squeeze, I don't know. But a lot of times when you see major volume, and then you see a light volume pullback just like this, and this wasn't even on my radar, but then you see buying pressure, and then low volume pullback, and then a little buying pressure, and then, you know, you have some volume spikes, but it's in a downtrend. And, you know, if a stock can go from 18 to $11 in a couple months, that's probably not my cup of tea. But look at the volume. The volume is undeniable. The pullback to support is undeniable. Probably should have been a trade, but I don't know if that's my cup of tea, but it's good to look at. For the simple fact is, if you have so much buying pressure, those are institutions, probably not going to turn around and sell it. So when it eases onto support and low average volume, that's where you need to step on the gas. Okay, so this is possibly my most painful stock, and I'm going to save it for last. So Camping World. If you've watched CNBC, you probably know who Marcus Lemonis is. The hit show The Prophet. I watched The Prophet. He is a solid dude. I'm a bet on the jockey kind of guy, and he's the kind of jockey I want to bet on. So he owns the majority of shares of Camping World, and he's the CEO. And when it went public, I said, you know what? I'm going to wait for that IPO base, and I'm going to buy some. So I only bought a little, which I should have bought more. Okay, and then my shares are more than doubled right now. Okay, I wish I owned more. However, sometime during this downtrend, this is why it sucks. Sometime during this downtrend, I was reading the Warren Buffett bio. And I was inspired, by his holding pattern, how long he holds a stock. And, as a financial advisor, I'd hear stories about these widows that had a stock for 40 or 50 years and it went from 10,000 to 5 million. So I said, you know what? I'm a young guy. I'm 33. I'm going to look for that stock that I can throw 10 grand in it and just forget about it for 30 years. Okay. By the way, I'm not telling you to go out and do this. As a matter of fact, don't do this. This is me. This is what's right for me. So I came up with Camping World. It was in this downtrend, and I knew I wanted to buy more, but the downtrend just got my emotions the best of me. And then it started to go higher, and probably around this time is when I was thinking I wanted to buy more. But I was like, you know what? I'm just going to buy it when it pulls back. Guess what? It doesn't pull back. It doesn't even break the 50-day moving average after it breaks out of this downtrend. And when this happened, I'm like, cool, it's going to break the 50-day moving average. It's going to come down and settle somewhere around 35, and I'm going to back up the truck. I'm going to put, a decent amount in it and just sit on it for 30 years. That's my plan. I'm going to sit on it for 30 years or until Marcus Lemonis is no longer CEO. But it didn't happen, right? And then, believe it or not, I own shares and it gapped up and it broke out to all-time new highs on Wednesday. It was up 8.5%, and I was angry about it. If you can believe that, you own stock in a company and it's up 8.5% one day, and I was angry about it, and I'm just sitting here laughing thinking, good Lord, stock, can you please come down so I can buy a lot of you? And it just didn't happen. And will it happen? I don't know. And will I have to buy it as it goes up? Probably, because I'm really thinking about an extremely long-term hold. But my point is, I should have done it in here, right? I should have just, said, if it truly is a long-term hold, Stephen, you should not try to buy as it's really bouncing off support. You should just, do what you said. Throw 10 grand in it and just forget about it. Even take it off your watch list so you're not watching it. Look at it once a year or whatever. And I didn't do it. And now the sucker, my shares are more than double. I mean, how many people are angry about a stock that gaps up? I want more. And, maybe I buy this breakout. I don't know. I'm sitting here pondering it right now, but man, this is hard to watch. It's hard to watch when I own a stock and it doubles, but I want so much more shares and I'm waiting on that pullback and it's not happening. Should have done it right here. So before I go on to talk about, some charts I really do like right now, I really want to just say, we're all human, and as many charts and stocks as I trade, I make mistakes. If you have your worst mistake of the year, email it to me, because every year I have people that love this subject and they just email it to me, and it's just kind of nice to communicate like that. But so I really just created a couple of key points that we can take away from my mistakes, from your mistakes, from everybody's mistakes. And I'm just going to read them off before we get into some charts that I really like. One is make trading mechanical as possible. I talk about using brackets, and we'll talk about BEAT here in a second. But make it mechanical as possible. If you know that, you buy right here and you don't want to see it go below that. Go ahead, put your stop in 1% under this, right? And then if you're looking for a 20% gain, put your, stop order in at a minimum of 20% gain. So you got your upside, you got your upside, you got your downside. You don't even have to watch the stock, okay? If you get that emotional, just take it off your watch list because your triggers are in. Invest, and this is really important, invest in trading psychology books and courses. It took years of pain before I really started just beating the market. It took a lot of pain. This trading it's a marathon. It's not a sprint. It doesn't happen overnight. I've had a really good year. And you want to invest most of the stuff. There are lots of good trading systems out there, and there's lots of great guys out there. So if you find yourself bouncing from, guru to guru, or, professional to professional, a lot of times it's not the trading strategy. It's what's between your own ears, and you're not able to quite handle it. Because even the best trading strategies, like we'll take my weekly reversal, for example, I have like an 83% win ratio this year. There's going to be certain markets where, it might underperform. Every trading system has markets where they're going to underperform in. So if you're interested in a trading system, make sure that you have kind of a longer term view and are willing to go through multiple market cycles. But trading psychology books like Trading in the Zone, which I listen to once a quarter on my iPhone, that is incredibly important to your personal growth as a trader. I don't think there's anything more important. I would go as much as say that trading is 75% psychology. Close your eyes and push the button. That's a funny rule. It's simple. I'm not telling you to buy a free falling stock. If we go back to the bit auto example that I showed you, it was hard, but it came down into support. That's a reasonable trade. It was expected to hold. It didn't. And I just kind of thought about close your eyes and push the button. I knew that's a trade that I needed to take. Even though it didn't work out, it's still a trade that I would have taken. Okay. So, just think like that and enter in places. And really the best way, to avoid max drawdowns in your portfolios, enter places where you only have to give 5% to find out if you're wrong. Buy above a cluster of moving averages that should hold. Okay? So my average loss this year is 3.2%. My average gain is almost 12%. So my average win is 4 times my average loss, because when I enter somewhere, I try to enter as close to a potential support zone as possible where I know it's not going to cost me a lot to my portfolio to figure out whether I was right or wrong. So I hope that was helpful. Let's go look at some charts that look interesting. I'm not a penny stock guy, so don't take that. I don't even know how this came across my screen, but Castle Brands, it is $1. I wonder if it ever was at one point in time it was $10. So it's came on some hard times, but if you look on the daily chart, it broke out of a downtrend line, clear as day, came through, busted through the trend line, above average volume, busted through the 50-day moving average, is pulling back, and I'll bet it finds support at that 20-day moving average. If it reverses at that 20-day moving average, might not be something too bad to consider. Beat. This was something I sent out on Monday. And it's funny, I was talking to a client and yesterday morning at the open, and Beat gapped up just like this, and it hit my 10% trigger and it automatically sold me out. I didn't even know what the stock was doing. All I know is it's like, hey, you just locked in a 10% gain. That's great. But why I have this on my inch, so place your brackets in. See, I had a stop loss right here. I had a 10% trigger. So it was going to hit it one way or the other, and the market forces, and it gapped up, and I didn't even look at why it gapped up, but it gapped up and it sold me out for a 10% gain. Why I have this on the interesting is because I bet after this gap up, I bet it doesn't come back down here. I bet it might fill that gap, probably find support at the 20-day moving average, and then go higher, okay? Plus it broke out of a downtrend. So this is something to keep put back on your watch list. Retail. Let's look at the weekly chart. Now this is just XRT. Look at this, man. I mean, actually that's not good. But look, it broke out. It broke through the black line, which is the 200-day moving average. The golden cross is happening. This is just the strong sector right now, and I'm sure it has to do with the holiday season, but look at this charging. If this reverses and it comes back down here, I would play this, but I might even play a juiced ETF to see if you can just get some holiday spirit, right? But I'm looking at retail stocks, and some of them are either extended, or I can't find one that I want to enter in that's near the perfect spot. So sometimes when I can't find that, sometimes an ETF or a juice ETF would be just fine. AMLP, weekly upside reversal and ETF. For those of you who are who like your dividends, check this bad boy out, 8.2% yield, and you're getting it at a pretty good price, and there's that weekly upside reversal right there. So an MLP ETF, looking pretty juicy. You know, place a black bracket on it, or at least place a stop under this. And if it does anything, even if it flounders around for a while, you're getting an 8.2% clip. So why the heck not? It's not my kind of trade, but it might be yours. Shake Shack. Okay, so Shake Shack and Zoe's hit earlier this week the 10% weekly reversal profit target. But the charts look somewhat similar to Shake Shack. You got these restaurants, and the group ranking is, it's getting stronger. The restaurant industry is getting stronger. So we want to keep our eye if restaurants come out of the crapper. I mean, this is a first stage rectangle bottoming pattern, and it's breaking out. And I'm not saying right here is where you want to enter. Got a pretty good return on equity. Supposed to turn around next year for 6% earnings versus minus. Pretty good sales growth. I don't know if that's same sales. Sometimes with restaurants, you want to look at same store sales, because sales can increase, but it could just be because they're opening more stores. I don't think this is where you want to enter, but think like a maker. It's breaking out. Does it pull back and find support at 20-day moving average? I bet it does. So I hope this was helpful. I really do. I hope you enjoyed this. I typically send out, 3 or 4 weekly reversal ideas to my paid subscribers. If you're wanting more ideas, you can just click the link on the email and take a trial and come see if you want to join us. Give me some feedback on this webinar. Let me know if you have any questions, and I hope everybody has a wonderful, wonderful weekend.